Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past, but also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was up 1.1% for the month ended August 2024. The Nifty Midcap 150 index was up by 0.3%, whereas the Nifty Smallcap 250 index was up by 1.2% in August 2024. Sector-wise, Nifty Pharma 6.6%, Nifty IT 4.7%, and Nifty India Consumption 2.3% were the top-performing indices, whereas Nifty PSU Banks minus 5.6%, Nifty Realty minus 3.7%, and Nifty Media minus 2.1% were the laggards. Global indices ended the month of August 2024 on a positive note. Dow Jones was up 1.8%, Nasdaq was up by 0.6%, while Financial Times Stock Exchange Group 100 was up by 0.1%. The India VIX saw a marginal increase in August 2024. It was at 13.39 compared to 13.25 in the previous month, up by 1.1%. The Chicago Board Options Exchange VIX saw a decline in the month of August 2024 and was at 15 as against 16.36 on the previous month, down by 8.3%. Foreign institutional investor FII were net buyers for the month of August 2024. Net FII inflows were 11,678 crore rupees. Domestic institutional investor, DII, bought stocks worth rupees 48,279 crores, whereas MFs were net buyers worth rupees 31,685 crores. Nifty 50 forward PE is now trading greater than one standard deviation over the mean PE, however it is still 5.4% below its peak. Nifty Midcap 100 is trading greater than 2 standard deviation above the mean forward PE. August was an eventful month with Bank of Japan, BOJ, raising its bank rates to 25 basis points. On July 31, 2024, the Bank of Japan increased policy interest rate to 0.25% from the range of 0 to 0.1%. and also laid out plans to reduce bond purchases to around Japanese yen, JPY, 3 trillion per month by March 2026, currently JPY 6 trillion per month, in order to curb inflationary pressures as well as support the depreciating yen. Also, the BOJ indicated the scope for further rate hikes. The hawkish shift by the BOJ led to a massive unwinding of yen carry trades, thereby leading to a correction in key global indices for the first 2 weeks of August 2024. However, after the initial panic, most of the market indices recovered. The shift in market sentiments led to defensives outperforming namely pharma and IT and some of the consumption-oriented names. Cap goods and infrastructure suffered and underperformed the broad indices. However, what impacted the markets favorably during the first week of August was indications of an imminent rate cut in the US, the world's largest economy. During the annual meeting of central bankers, finance ministers, financial market participants from around the world, the US Federal Reserve's chairperson, Jerome Powell, strongly indicated that rate cuts would begin shortly in the US. The decision to start cutting rates is to support the labor markets, which have been showing signs of weakening for some months now. Growth momentum in corporate profits has slowed down. The lagging sectors were power, chemicals, and construction materials, while healthcare, capital goods, and realty outperformed. The sequential decline in profits in banks, led by increasing provisions and tepid credit, was not taken too favorably by markets. In general, poor results due to intense heat wave and general elections kept the markets subdued. Corporate India's profitability moderated during Q1 FY 2025, led by quarterly decline. Quarter-on-quarter PAT contracted by 5.3%, along with an adverse base. Within 20 key sectors, account for 96% of the aggregate PAT. Crude oil, power, chemicals, iron and steel construction materials and aviation, noted a contraction in PAT during the quarter. We expect the adverse base effect to impact growth rates in the second quarter of fiscal year 2025 as well, and could impact market sentiment. Real GDP in Q1 FY 2025 grew by 6.7%, lower than the robust growth of 8.2% in Q1 FY 2024 and 7.8% in Q4 fiscal year 2024, largely led by unfavorable base and lower government spending. Private final consumption expenditure, which accounted for 56.3% of the GDP, grew at the fastest pace in the last 7 quarters by 7.5%. Gross fixed capital formation or investments also grew at a strong pace of 7.5% in Q1 FY 25, despite lackluster government capital expenditure during the quarter, indicating some pickup in private capital expenditure as can be seen by the strength in the construction sector. On the supply side, industry segment grew at a strong pace of 8.3%, higher than 6.0% in Q1 FY 24 and only marginally lower than 8.4% in Q4 FY 24. Manufacturing contributed 17.6% to the GVA in Q1 FY 25, up from both 16.8% and 17.3% in Q1 FY 24 and Q4 financial year 2024 respectively. Services growth, however, slowed from 10.7% in Q1 FY 24 to 7.2% in Q1 FY 25, partially attributable to the heatwave and general elections. Capital expenditure by the central government picked up in July 2024, following a lackluster first quarter. Higher capex during July 2024 gives assurance with respect to the continued capex push that the government has been strongly advocating for in the last couple of years. For the remaining of the current fiscal year, the government needs to spend about 8.5 lakh crore rupees, which translates to a monthly spend rate of rupees 1.06 lakh crores. This target looks manageable for the government and in all likelihood would be able to achieve it till the end of the fiscal year. Markets have become more volatile as foreign portfolio investors' flows have turned unpredictable. Domestic funds have also turned cautious, and we are witnessing lower volumes, which could have an impact on liquidity. While we continue to be optimistic on scope of a mid-cap and small-cap revival, we will also be reviewing relative valuations and performance and make necessary adjustment to the portfolio. Earnings momentum is expected to be weak in the next quarter as well, as infrastructure and capital goods will face the impact of lower government spending. We also expect consumption recovery to be gradual. Inflationary pressure is expected to ease sequentially as well, though it may not ease consumer burden significantly. We are also monitoring the consumer credit cycle, as we are surprised by the sudden deterioration in asset quality. This could dampen consumption to some extent and impact bank profits as well. Government finances are robust and hence there will not be any negative surprise in the downward bias of interest rates due to benign inflation. We expect that lower interest rates could act as a support to equity market valuations. Sporadic corrections in equity markets led by sharp stock moves cannot be ruled out as the retail participation is high. Higher capital gains taxes have also dampened retail sentiment, as can be seen by lower volumes. This could lead to both price and time corrections in the market, which makes it a sensible time to increase allocation through SIP, given that the macro fundamentals are favorably aligned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.